Let's get across the market open. Kyle Rodder joining us from capital.com. Kyle, welcome. Joining us from London. Let's though start on the other side of the Atlantic there, what we saw on Wall Street. Expectations, of course, that there's going to be an end to the US government shutdown with the House of Reps voting in a few hours' time.
Yes, and I think the market's basically pricing in that is going to happen. And the question is now whether that's a boost to sentiment or whether we've seen it priced in and there might be even a sort of a degree of, buy the rumor, sell the facts. If you looked at price action on Wall Street, we're still seeing a high degree of indecision. I think there's an element there where we have had this relief rally because of an end to the government shutdown. And as we saw at the back end of last week, not just from the data, which clearly showed that the shutdown has weighed on consumer sentiment and has probably had an impact on economic growth, but the prospect of this end of the shutdown has sort of led to this, as I said, kind of relief rally. So, really probably market participants, or at least commentators like me, were probably understating a little bit of this significance. Now that it's kind of baked into the price, the kind of question becomes, now that, there is, of course, to this indecision, sort of what is the next catalyst? And, there's still this talk about the prospect of rate cuts going forward, or perhaps fewer rate cuts than previously expected. There's also the deluge of data that could come next week because of the end of the lockdown, albeit, some technical issues seem to maybe indicate that we'll not get the October labour force report. And we've got NVIDIA next week as well. So after that sell-off last week, we're really in this kind of interesting kind of crossroads, which really at the moment price action sort of suggests we could quite truly go in either direction. We just need to, basically receive the catalyst.
Interesting. We did see that rotation out of tech stocks into the cyclicals.
We did, and I think largely that was sparked by that weak private payrolls report that obviously is coming through from ADP, and indicated that pretty much to the 4 weeks to the end of October, the US economy was shedding on average about 11,000 jobs, and that increased the implied probabilities of a December cut from the Fed to about 70% and sparked that kind of rotation trade into cyclicals. The Dow being up at record highs last night, but for the most part, the S&P 500 trading fairly flat, and the Nasdaq being in negative territory for almost the entire session, certainly closing lower than where we gapped to at the open. The issue is here now, what is the Fed's reaction function and how will it respond to the data that it gets as it comes through? Because not that the Fed necessarily wanted to or doesn't want to cut rates next month, but the whole notion of cut can't be a foregone conclusion, which is verbatim what Powell told us a few weeks ago, is about sort of maximizing the optionality that the Fed has going into this decision, depending on the balance of risks to the US economy and whether we continue to see this labor market deterioration balanced against potentially this, stickiness that we could be seeing inflation, again, neither of which we have a great deal of clarity on because of a lack of data. So the markets have rotated towards those cyclicals on the anticipation of a bit of a rate cut, although at the margins that kind of got backed out again a little bit in the price overnight. The other thing too is tech stocks are looking very expensive. There's still that sort of fear that maybe the market there or tech companies have run too far too. So nevertheless, again, it is that sign of sort of churn, possible indecision at the moment in the markets. And again, that kind of real need for a catalyst, whether it be from macroeconomic data or from corporate news, to really drive the next move in the markets.
Kyle, a lot of action in commodities at the moment. Gold on the move again. Is that more of a momentum trade at the moment, particularly given perhaps, I guess, when you're looking at the prospect of rate cuts, the shutdown and so on?
I think it's an indicator of the run at hot trade, and I think one thing that perhaps hasn't been emphasized enough this week when it comes to the broader market narrative was that Truth Social post from US President Donald Trump, which amongst other things pledged a little bit of a handout, or I really shouldn't call it a little bit of a handout, it's quite a substantial $2,000 handout to households as a more or less subsidy for or redistribution for the from the income that has been achieved from tariffs. That's playing into this whole sort of run it hot notion, which I think the Fed is actually quite cognizant of, and is why it hardened its language at its last meeting, effectively to say that markets are still pricing in steep interest rate cuts next year, at the same time that deficit spending in the States and in other parts around the world as well, it has to be said, are going to see very significant fiscal stimulus coming through. I think gold is reflecting that. If you look at the other things that, more or less gold has been driven higher by, say the last time it crossed the 4,200 threshold, well, it's geopolitics. That's not such an issue right now. Trade policy, not such an issue right now. Fed policy has been, a little bit of a drag. But overall, I think it is this notion that, the economies are going to be run too hot. There is that debasement trade going on. And very quietly, gold is picking up once again and is only sort of 3 or 4% away from record highs.
Meanwhile, oil going in the opposite direction. This dropped about almost 4%, also off the back of an OPEC report, essentially looking at the prospect that supply and demand are going to come into balance next year.
Yeah, and it was a relatively innocuous statement on the surface of things. The demand report more or less suggested that, like you said, the balance of supply and demand would be roughly neutral going into next year. But that was a revision from the last projections from OPEC, which sort of suggested that it thought oil would be, or the crude market would be in a modest deficit going into next year. So there is this notion that, one, a little bit like policymakers at central banks, that if it's not forecasting more or less say 2 to 3% target inflation, well, policy is wrong and it's not doing its job, or it's not targeting things the right way. OPEC always has to sort of have projections in place that suggest that they're in control of the market, and that the balance of supply and demand is more or less under control, and moving as planned, or will be moving towards plans. Last night sort of suggested that this rhetoric of a deficit is going away, that the glut that market participants already fear because of sluggish growth, but also the fact that there has been this pretty significant increase in output from OPEC over the last few months, will continue to contribute to this kind of oversupply and therefore downward pressure on prices. We also had some reports last night that the Russians may be entertaining talks with the Ukrainians again. That may have had an impact, but for the most part, OPEC rhetoric is looking increasingly soft on the demand outlook, and that was the reason for that sort of big 4% move in oil prices, and we're now only a couple of bucks away from the recent cycle lows.
And Kyle, locally, the focus will be on the monthly jobs report. Expectations, perhaps unemployment is likely to tick lower.
Yeah, down to 4.4% after that jump in the September rate to 4.5%. And, this really could potentially test the RBA's reaction function because, as we saw in the Statement of Monetary Policy last week, not only did it talk pretty tough about the inflation outlook and project, above target inflation for a little while, it still basically forecast that would happen in conditions where the labour market would be relatively stable. In fact, the unemployment rate would drop to around 4.4% by the end of this year. If we see perhaps again an upside surprise to the the unemployment data, and a downside surprise perhaps to the employment change, as we have seen in recent readings, there has been that trend of sort of underwhelming jobs growth and a higher unemployment rate. Well, that calls into question whether the markets think the RBA will kind of back off that hawkish rhetoric and start pricing in that cuts could indeed come again. Maybe not before the end of this year anymore, but certainly in the first quarter of next year. At the moment, the markets are only pricing in basically a 50% chance of another cut at all. Or will the markets basically price in that given inflation is sticky, that a lot of that's driven by the fact that although demand is weak, by the RBA's own logic, RBA demand is sort of exceeding aggregate supply at the moment and keeping prices stubborn. Will the markets think, oh, hang on a second, this is a bad mix, but the RBA will stick to its guns and still stick to its sort of inflation focus, and sort of allow a bit of a tick up in the unemployment rate, which would be bad for the economy, broadly speaking, but would make it a little bit easier at the margins for the RBA to hit that inflation target. So it could be a really significant one if we do see a surprise here. And again, it will give us a bit of an assessment on, to what extent the markets thinks that the RBA has the guts, arguably, to tackle inflation, persistently high inflation going into next year.